Good afternoon, my name is Matt Schwal, and I'm going to begin this presentation on behalf of Group 4. We conducted a financial analysis of three companies involved in the solar panel supply chain. That's REC Silicon, which is a producer and a miner of silicon materials used in solar panel production, SunPower, which is the producer and manufacturer of solar panels, and Sunrun, which is a commercial and residential installer of solar panels. In this presentation, we will present a financial analysis of each of these companies, as well as present a 5-year forecast for one of the companies, and make a recommendation for which of the companies would be best to invest in. To maintain consistency in our evaluations, we use the same 8 ratios to evaluate each of the companies. First, we'll begin with REC Silicon. They are headquartered in Norway with production facilities in Moses Lake, Washington, and Butte, Montana. They are the leading producer of advanced silicon materials, supplying high-purity polysilicon and silicon gases to the solar and electronics industries worldwide. They are the largest manufacturer and supplier of silane gas for production of semiconductors, flat panel displays, and many solar cell technologies. They are also the only producer of silane gas in the United States, which is becoming an ever more critical material for lithium-ion battery production. They are also one of the world's largest producers of polysilicon for the PV industry, and ultra-pure FZ polysilicon for the electronics industry, which are used in hybrid and electric vehicles, wind energy, high voltage transmission, and other products. Despite these apparent strengths, business has been difficult. Since 2004, REC Silicon has been effectively blocked from participating in the polysilicon markets in China, which represents roughly 25% of REC's business. This is due to tariffs imposed by China on polysilicon imported from the United States. This is also a part of the ongoing trade war between the United States and China. As a result of the tariffs, REC Silicon was forced to reduce capacity at its Moses Lake facility to 25% in the second quarter of 2018. And then in April 2019, the company raised additional capital through a private placement of equity to provide the necessary liquidity. As part of the equity raise, the company plans to shut down its Moses Lake facility entirely on June 30th, at least until the tariffs are lifted. This is intended to ensure that the company maintains sufficient liquidity for the future. The company is hit particularly hard by these product-specific tariffs in that it does not have a very diverse portfolio. It exclusively deals in the mining and production of silicon-based materials, but silicon itself is used in such a wide variety of products that tariffs on any one particular industry do not necessarily hurt the financials of the company long term. Now on to ratios. The first is operating margins. You can see here that the company's gross operating margin has improved dramatically over the last 2 years. This is very likely to do with the fact that the company shut down production at its Moses Lake facility to 25%, which reduced operating costs and brought expenses more in line with revenues. However, if you look at return on assets, we can see that the ROA has dropped dramatically in the past 2 years. And that's to be expected because as the company has shut down operation at its facilities, it's just not producing as many revenues based on its existing assets. So this makes sense. This return on equity ratio is showing us more of the same. The company is ineffectively utilizing its assets in that its production is very low and it's not producing a revenue with the assets that it has. Sales per day have dropped dramatically. This is because the Chinese market has made up such a huge share of the company's business, more than 25%. And the solar industry has grown so competitive that the prices just aren't what they were. So spread out over 365 days, it gives the appearance that sales are down. Here we can see that as sales revenues have consistently declined since 2015, the percentage of receivables as a part of overall sales has increased, which is leading to the perception that turnover has decreased, which is not necessarily the case, especially since 50% of the company's revenues actually come from just 3 companies. So this is less to do with the effective collection of receivables by management and more to do with the fact that sales volume has just decreased. Next, if we look at the company's operating cash flows, we can see that between 2016 and 2017 there was a steep increase in cash and that has to do with the sale of intellectual property rights to a Chinese company in 2015 that resulted in $198 million in cash to the company. But in 2018, you can see there's again a steep drop off because expenses simply continue to outpace revenues. So this isn't necessarily an indicator of financial hardship in the short term, but in long term, cash flows are going to need to exceed expenses for the company to be profitable. Here we can continue to see this cash flow problem reflected in the PE ratio, where this negative ratio indicates the company's been losing money since 2015. This is going to continue to be a problem so long as they're operating at a loss. Here we can see that between 2017 and 2018, the company took on an increasing amount of debt, resulting in a debt-to-equity ratio significantly higher than in years past. The company's really going to want to get this under control, otherwise it's going to end up being overly leveraged. So what does this all add up to? The Chinese tariffs on U.S. produced silicon have clearly impacted REC's bottom line, and it's not clear at all whether those tariffs are going to be lifted anytime soon. Revenues are down year over year, but the company is improving its operating margins by reducing or shutting down production at its Moses Lake facility. This doesn't appear to reflect so well in the ratios. However, this is likely the prudent decision if they want to keep expenses in line with revenues. Long term, the company's predicting neutral cash flows under current market conditions. However, they are making some wise moves, as in 2015, the company sold its core polysilicon manufacturing technology, which allows them to produce silicon with far less energy usage than some of their competitors. They sold this to a joint venture in China called Yulin JV for $198 million, which I referenced earlier, and a 15% ownership stake. But they do have a very nice option to increase that to 49% should the market conditions dictate such action. Therefore, overall, we don't think it's prudent to invest in REC Silicon at this time. That recommendation could change depending on how the solar market develops, whether tariffs are lifted, and in particular, how the lithium-ion battery market grows as it relates to its need for silicon-based products.
All right, this is Nick, and I'll be doing a quick financial analysis on SunPower. So, quick introduction. They were officially incorporated in 1985, headquartered in Silicon Valley, and already produced more than 18 million megawatt hours of total solar energy. Here's just some of their strengths. World's highest efficiency solar panel, more than 750 patents, and a diversified global portfolio. Some weaknesses and risk mostly revolve around the import tariff. But in 2017, they decided to shift focus from leasing agreements to completely purchased solar panels for installers and large-scale solar power plants. So this resulted in selling off 45,000 solar leases worth $1.4 billion in contract payments. Additionally, in anticipation of the impending import tariff, they imported 3.5 to 6 months worth of solar panels in the fourth quarter. In 2018, China unexpectedly cut these solar incentives in the summer and resulted in a 30% drop in solar panel prices. In January of 2018, also, the 30% solar panel import tariff was put into place. And this is a problem for SunPower because they have a manufacturing facility in the Philippines. Additionally, $369.2 million of write-down of obsolete manufacturing assets in order to upgrade to next generation technology solar cells. This is to make them more efficient, resulting in a simplified manufacturing process and lower cost. So operating margin, 2015, 2016, they're doing relatively well considering the market that they're in. 2017, 2018 was the experiencing the restructuring and the solar panel import tariffs that really had the major effect on this. Return on assets. This is really where you can see the effect that the write-downs had on the return on assets. But again, this is just to make room for next generation technologies. Same thing with return on equity. the write down effect. But again, this is just to increase their margins and hopefully lower their operating costs. All right, sales per day. Interesting here is despite all this market volatility and negative and uncontrollable forces, sales per day has stayed relatively consistent. Um, However, the first quarter of 2019 did show a decrease. Could be indicative of the new business model, but hopefully not a trend going forward. Accounts receivable turnover, you can just see the dramatic effect that changing their operating model has had by moving away from residential leasing agreements. So to wrap it up, tariffs had a pretty devastating effect on SunPower. They were granted a tariff exclusion in September 2018, which is estimated to be worth about $100 million annually, which gives them an edge on the market for at least 2 years while the current administration is still in power. They have announced that they're looking for a partner to grow their manufacturing operations in the US and Asia, just because they cannot compete with the other industry leaders manufacturing scale. So they need investment to increase their manufacturing scale. All right, we also chose SunPower for our 5-year forecast. Some assumptions. All values used to forecast ratios were either trended or averaged to the end of 2019 based off of the previous 4 years of data. And then off that 2019 value, years 2020 through 2023 were extrapolated. The 3 scenarios presented will be based on anticipated level of performance of high, medium, and low. Some items of note for the assumptions: sales, anticipating an increase from 5 to 20% for median to high levels of performance, respectively, and a low level of performance would result in a decrease in sales by 20%. Also, with operating costs, a high level of performance would range from, you go from a decrease of 20% to a medium range, which you'd increase in your operating costs to 3%, and to a low level of performance would be an increase by 20%. So the operating margin, you can see this is probably where you can see the most effect of the forecasted changes in sales and operating expenses. So obviously, we believe that we can fall within anywhere within these margins. Hopefully, on the higher end, obviously, but anywhere within there. Return on assets. This is just kind of a quick overview on all the assumptions that were put into making this. But again, just another sign that they can turn around if these new restructurings and the new tariff exemption really help out the business. Return on equity, good indication the company is trying to reduce the level of debt it currently has. And sales per day, just shift from offering residential lease agreements to building engineered solar panel solutions from the ground up, anticipating an increase of sales to 5 to 20% based on the level of performance. Price to earnings ratio, number of outstanding shares was averaged over the previous 4 years and kept constant. Share price was forecast to increase between 3 to 15% annually, depending on the median and high level of performance, respectively. So that's all I have, and I will pass it off to Jay, who's going to go over Sunrun. Thank you.
Final company that we're going to be looking at is Sunrun Solar. Sunrun Solar was founded in 2007 in the Bay Area, specifically in San Francisco, and it quickly became one of the industry leaders in the rooftop solar industry in the United States. Sunrun actually founded the business model of the power purchase agreement in the residential sector. Some of the strengths that Sunrun has: Sunrun is the largest residential solar company in the United States by market cap, reaching almost $2 billion, which is pretty by and large ahead of their closest competitors. So their closest competitor right now is Vivint, and they're valued at about 600, 700 million, so quite a bit less. This gives Sunrun a pretty big advantage over its competitors via economies of scale. plays a pretty big role here. Sunrun has a strong list of channel partners, including Comcast, Costco, Home Depot, and Lowe's, and I believe this will ensure a steady stream of business moving forward. On top of that, Sunrun is the leading installer of battery backup technology to residential homes. So moving on, we can take a look at some of the weaknesses and risks associated with Sunrun. If you look at Sunrun's installed cost per watt, it could be a lot lower. If you look at some of the other players on a global scale, specifically the ones in Europe, notably in Germany, listed in the Lazard 2018 report, Sunrun's installed cost per watt is a little bit higher than a lot of those leaders. So I think there's a lot of wiggle room there and room for them to grow. Sunrun will be losing out over the 30% investment tax credit over the next few years, which will negatively impact their business model. On top of that, Sunrun's entire business model right now, except for markets with batteries, revolves around net metering in the United States and those policies being in favor of solar. On top of that, many consumers these days are choosing to invest in off-site community solar gardens rather than investing in on-site projects. And finally, there is a 30% tariff on all Chinese panels that creates enormous pressure to buy panels elsewhere. Moving on to Sunrun's diversity. Sunrun is relatively diversified and is involved in a couple different markets. Sunrun owns AEE Solar Distribution. It's a wholesale panel and inverter distributor. They sell those panels and inverters to a lot of the local installers in the areas in the United States. On top of that, Sunrun owns Snap and Rack racking systems. So they own their own racking solution and also sell that racking solution to hundreds of other solar providers in the United States on top of just Sunrun. And finally, Sunrun is involved in residential leasing for rooftop solar and also residential solar purchasing and financing for rooftop and ground mount solutions. And also it should be noted that battery backup technology is another part of Sunrun's product portfolio. Moving on, looking at Sunrun's operating margin, they are experiencing year-over-year growth here. This is kind of an indicator of their profitability, and we are seeing substantial growth. Each year from 2015 to 2018, there has been an increase, which is good. On top of that, if we look at the sales per day, we see a consistent year-over-year increase as well. This kind of implies that Sunrun is not only profitable, but also growing pretty substantially. Moving on, looking at the return on equity, this graph is a little weird. It actually moves from right to left. But as you can see, Sunrun in 2015 started off with kind of a rough year and posted negative return on equity that year. But after that, they started dipping into the positive a little more. And from 2016 to 2018, they have consistently been pretty much in the positive, except for Q1 2019 looks like they posted a negative. But other than that, we've been doing pretty well with that return on equity. Moving on to cash flow. So we have three different forms of cash flow here. We have cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. The cash flow from financing activities actually ends up making them cash flow positive here. So even though they're posting negative cash flow from operating activities and investing activities, those two combined are actually still going to be less than the cash flow from financing activities. So they are still cash flow positive because of that money they're getting from finance. It should be noted though that their cash flow from operating activities, they really should be working on getting that towards neutral, if not cash flow positive, so that they can increase their profitability and make a clear path forward. Moving on, looking at Sunrun's leverage. This is a little bit concerning. We can see an increase in Sunrun's leverage since 2015. By 2018, it looks like their leverage is, or their debt to equity ratio is about 1.6, which is pretty high. Although it should be noted that Sunrun's entire business model revolves highly around debt via leasing, power purchase agreements, those sorts of things. But despite that, they should definitely work on getting that debt to equity ratio down closer to 1 there. In terms of different lawsuits, legal issues, and debt covenant compliance associated with Sunrun, in March 2019, Sunrun did agree to pay $5.5 million in damages associated with robot calls made to individuals who had not authorized consent to such calls. This was somewhat minor in the grand scheme of things and didn't really impact Sunrun at a huge level. On top of that, in January 2013, a man filed a lawsuit against Sunrun claiming they overinflated the rate in which electric rates increased. This suit was settled out of court, and everything was taken care of there. And those are basically the only two major lawsuits that have been filed against Sunrun. On top of that, as of 2018 in December, Sunrun is in compliance with all of its debt covenants, so that is a positive. Basically, what this means for Sunrun, Sunrun holds a very strong position in the United States as the largest residential solar provider. As battery technology continues to develop, Sunrun will rely less and less on net metering policy. And on top of that, although the tariffs and the ITC phase out will certainly have negative implications in the short term, Sunrun should have the ability to pull through as the solar industry matures in the United States. So let's move on to our recommendation to the investors. We've looked at SunPower, we've looked at REC, and now we've looked at Sunrun. We saw some shaky financials across the board. Everyone wasn't perfect, but we decided to go with Sunrun. And we did that for a couple reasons. Starting off, Sunrun has increased profitability each year since 2015, as the operating margin has increased year over year and has implied definitely a path towards profitability. On top of this, Sunrun, unlike SunPower and REC, has shown year-over-year growth, as the sales per day has increased dramatically each year since going public in 2015. This is a huge sign. This means that Sunrun is increasing its marketing efforts. This means that more and more people are choosing to adopt Sunrun, and it doesn't look like that's slowing down anytime soon. So that's definitely a clear indication that this might be a valuable stock. And finally, as the development of battery technology continues to move forward, this will help take Sunrun's business model to the next level. And it also provides a clear path forward despite whatever net metering policies will exist in the United States. So we know that that had a huge impact on the business model in the past, but with battery technology, it completely takes away that uncertainty and should give investors more peace of mind in terms of a long and sustainable future with Sunrun.